My name is Imogen Rose-Smith. I'm a senior writer with Institutional Investor magazine. In my day job, I'm also on the content committee for this conference, so it feels like I remember doing conference calls on this in January, organising these things, so it feels like a long time to really worthwhile. And I'm also moderating this panel. So I'm excited about the environment panel because I think that there's a lot of panels actually that we're excited about this conference, but I think the environmental investing, as you've already seen, sort of some of the conversations that are coming out with impact investing, like a lot of impact is still a bit of a nice to have, right? And a lot of the questions are like, what is your impact? What do you want to be focused on? What are your issues? And I think, with the environment, it has become much more of a need to have. And the question is not, should we be considering the impact of climate change when we talk about investing? Well, that's why you make notes.
I was just admiring how great a job you did.
The question is, how do we go about doing that? And what we've really seen, I think, in the last 5 years is that there is now a plethora of ways to invest and things to do, and that is sort of what this panel is going to represent. So I'm going to start by so you guys are organized, as I sort of said, we're doing this from most funky to least funky in terms of investing type. With least funky being fixed income, boring, and being what those guys do at that end. And again, those of us who sort of come from an institutional background where we're much more used to the sort of BlackRock, fixed income, traditional approach to investing, and a lot of where impact has sort of lived historically has been a little more funky in the scale. And I think one of the things that is happening is bringing all these conversations together. So what I'm going to have you guys do is sort of start by introducing yourselves, and then we'll have a conversation. And also just to sort of open this up to the room, and if people want to ask questions, they should just feel free, because I hate moderating because I'm scared of public speaking. So the more that other people do it, that will be better. So, yeah, with that. Oh, and everyone, you guys have to speak into the microphone, recording it, and they were very clear about that. So, who wants to start? Most or least funky?
You want me to start? You start. Okay. I'm not really sure how I feel about being funky, but this might be the only time in my life that I'm the funkiest, so I'm going to embrace it. My name is Taryn Goodman, and I'm the Senior Director of Investment Partnerships at NatureVest. NatureVest is the impact investing unit of the Nature Conservancy. The Nature Conservancy is the largest conservation organization in the world. We do a lot of great work using philanthropic dollars, but realize that we are never going to move the needle with philanthropic capital alone. We heard a bit about this earlier today on the panel with Elizabeth. So in 2014, we launched a dedicated impact investing unit. We source and structure investments, source capital for those investments, and talk about our work to try to get others to also make investments for conservation. We work in 5 different areas: water markets, sustainable agriculture, working landscapes, debt conversion for climate mitigation and adaptation, and green infrastructure for stormwater mitigation. In the past 2.5-ish years, we've closed about $200 million worth of deals. The idea is walking before you can run. And I think this is why we're funky, because all of our deals are pretty bespoke. We're showing that these models work using blended capital, as we heard about earlier as well, and then with a goal of scaling and replicating so that we can eventually attract commercial capital. There is a gap of somewhere between 300 and 500 billion, with a B, dollars that's needed a year to meet our conservation goals. And so that is the gap that we are looking to cover.
Hi, my name is Sydney Novelis, and I'm Director of Investor Relations and Operations at Sunfunder. So Sunfunder is a financing intermediary business, and we're focused on unlocking capital for solar and emerging markets. And we do because we bridge the financing gap that exists between investors and companies that provide solar technology to residential and commercial end users. We do this because I think this room is kind of familiar with the off-grid solar renewable energy environment in Africa, but just for those that are unfamiliar, more than 2.5 billion people live with unreliable access to electricity, and in these parts of the world, solar is the most economically viable solution that's replacing kerosene and diesel. Yet solar companies claim their main barrier to grow and scale their businesses is lack of access to finance, and that's where Sunfunder steps in. we source, conduct due diligence and monitoring and structure deals to tailor the needs of this market. So for solar companies, we offer a variety of debt financing, and to investors, we offer an opportunity to invest in a diversified, vetted, and high-impact portfolio of off-grid solar loans through our private placement debt funds. We're both based in the U.S. and Tanzania. We believe in having deep understanding of the loan markets and having close relationships with our customers. Right now, we're focused on the East African solar market, but have done to Ghana and India, and are looking to expand to South Asia and West Africa in general. For our track record, we provided $14 million of loans. So I think, in the most funky way, it's also because we're still in a smaller scale, but definitely have big goals. We've worked with 27 solar companies. We've raised $35 million of debt from institutional and individual investors. We recently, closed our $50 million fund with OPIC, and we're looking ahead. We have a loan default rate of less than 1% and a repayment rate to investors of 100%. And we're really, at this stage, we're really looking to scale and grow and learning more from the least funky players in this room.
I'm Paul Ingram. I had previously worked at APG, which is ABP, which is the largest European pension fund. We manage about $500 billion worth of assets. I worked on an opportunity fund team. There we had seen firsthand a lot of the challenges that well-meaning, responsible investors face from a fiduciary perspective in accessing products and making investments that do have an impact. So our opportunity fund team has just recently now left APG, and we're working on an energy transition opportunity fund. I have a lot of thoughts around, kind of critical thoughts around the space, I think. So I'll try to carefully.
Hi, I'm Connor Platt of Evo Capital. We build public investment solutions that balance sustainability and performance. We built an index that underlies a US-focused ETF, trades on the New York Stock Exchange. Built some other indices for a global pension fund in Australia, and we're in the process of launching a long-short fund to use sustainability data to find good sustainable investments and obviously short unsustainable business models. I'm happy to talk more about our process and how using environmental data, specifically data around the efficiency of supply chains, can help find better investments.
Hi, I'm Ashley Schulten. I'm with BlackRock, a large global asset manager. I'm here to share you that we want to be funky too. But I would say that what we're finding is that thinking about climate risk is not necessarily funky anymore. It's becoming more mainstream. And so our clients, we think of them in two ways. There are clients who are concerned about the impact on their portfolios from climate risk, whether it's from regulatory risk or fiscal risk. And then there are clients who are thinking about the impact of their portfolios on climate. And so that can take the form of impact investors or of universal owners that are really thinking about the 20-30-year horizon. So at BlackRock, we launched an impact platform about, 18 months ago? That is sort of the umbrella over the firm that coordinates these issues for us on a global level. I specifically work within fixed income, and I specifically work on climate. And so I am working on things of tools that portfolio managers can use to think about climate risk in their portfolios, and also working on developing products that are digestible for what might be the typical BlackRock investor. So large liquid market products, things that are have CUSIPs and ratings and are indexed and are really digestible to that community. And one of the things that I specialize is on green bonds. And so I'd love to mention some green bond conversations in this room.
So I was in a meeting yesterday, and one of the guys in the meeting, Doug's a lawyer, and he's a very progressive environmental guy, and he sits on the board of a little environmental foundation. Let's say they've got 200 million in AUM. And we were talking about impact-ish stuff. And he was like, Imogen, I understand what you're saying, but we've been talking about this at our foundation for 2 years. We can't get our act together to align our mission with our investing. So here you have like a foundation that clearly should be doing the types of investing that all of you guys represent, and yet they're not doing it. So what is, we know there's this huge need, there's a huge risk associated with climate change. We know there's a huge need to have this thing. We think there is this huge demand out there. You guys represent sort of high quality, institutional type products, even the guys down the funky end of the table. So but if we can't get the Dougs of this world to invest, like what is the hope of getting everyone else to invest? So what is the mismatch here? We've also been hearing about sort of in the plenary sessions this morning, and how do we create urgency around it? Someone?
I'll start. So I think for us, what we've noticed is that the universe of investable products for a lot of our client base has just not been there. And so I'll take, for example, infrastructure. So if you want to have a positive impact, obviously an honest asset class for you is renewable infrastructure. But if you think about asset allocations within large institutional investors, maybe they have 2% of their asset allocation to infrastructure. When you think about BlackRock's platform, I think our infrastructure business is about a little over $9 billion in the context of a $5 trillion asset manager. So it's difficult for investors to all of a sudden say, I want to be green, and I'm going to change my asset allocation mix, and now I'm going to load up on renewables, or I'm going to load up on private equity, or I'm going to take risk or liquidity constraints that weren't. Sorry.
So as I say, infrastructure is a great example, right? So I'm an institutional investor. I already have an infrastructure allocation. But I guarantee you that 90% of my infrastructure allocation is not in clean infrastructure. And I guarantee you that like BlackRock's $9 billion infrastructure portfolio is largely not in renewables. So what...
Actually, it is. A lot of it is in renewables. I think $5 billion is in renewables.
Really,
but yeah, it's a big push for the firm.
Like what needs to happen to make that shift so that I recognize in my infrastructure portfolio that I already have, I can be doing this?
Well, I don't know if the question is that you want to put it within your infrastructure portfolio, because again, we want to go after the asset allocation that doesn't necessarily need to be in 10-year lockup type of money. So there are transformative ideas that are happening in the fixed income space, like green bonds, that allow investors to get exposure to climate-friendly assets without really changing what they're normally doing, without changing their investment-grade corporate bond portfolio. Another concept that has been talked a lot about, and there's some small examples, are the sort of the rebirth of securitization market. And so getting private money, public money, to come in and provide full loss guarantees to private capital in a way that is different than what we're seeing now in terms of these small niche $100 million deals. So I know IFC has publicly put out that they're looking at a $2 billion EM green bond securitization that's going to have first loss guarantees from a public source. So after COP21, I think there's been an increasing amount of pressure on public bodies to think about ways to pool in private capital, with the acknowledgement that the money that needs to be spent to get ourselves off the 6-degree trajectory is more than public bodies can spend. And so what are the creative ways that they can pool in private capital? And first loss sort of securitization structures are an idea in that space.
I'll just say that I think that a lot of people believe that climate change is a pressing issue and things should be done to solve climate change soon. But I would just caution that, you don't want to have the clean tech thing happen to the impact space, right? So you don't want to have people coming into investments that aren't going to be profitable, and then 2 years or 3 years from now saying, hey, this actually doesn't work at all. This is really bad. And so they sort of avoid the space, right? So I think that although there's a need for haste, I think we should moderate that with the fact that there's a lot of institutions that have, at EPG, right, we had 4.5 million Dutch pensioners we needed to think about all the time, and some of these guys are making 600 euros a month on their pension, and we can't lose people's pension money. So we shouldn't let haste get in the way of recognizing that these fiduciaries are there for a reason.
But it seems like we're in this weird space where on the one hand, it's kind of like the thinking fast and slow problem, right? It's like, on the one hand, there is still this overhang from clean tech and this skepticism that says, solar in particular, we'll come to that in a second, doesn't work, and that as a result is restricting investors from acting.
Right.
And on the other hand, we're getting excited about stupid stuff. Right? So, and this is a kind of question for Connell, like the clean energy ETF, right? It's very clear to me that there's going to be there are a bunch of parallel clean energy ETFs out there. So people are doing sort of bad stuff or potentially bad stuff and not doing the good stuff. And the danger is that the bad stuff blows up and then no one does anything and the world goes to hell.
Okay. Well, with that, we can...
Unpack that.
Yeah, sure. I think that what we're starting to see over the last 18 months, pretty much when BlackRock announced Impact, was that this thing got a lot more real for Wall Street, which is great. And what I think people are starting to see in a world of low returns, you need to use other data sets that help uncover better operated companies. We've seen it's a short track record, but our index has outperformed everything in the broader space. It's important for it to be broad. It's important to use data sets that allow you to have the most diverse portfolio you can have in the context of an ETF. But these data sets also allow you to do things on the active side that weren't available 5 to 7 years ago because the data wasn't as prevalent. You're going to have this overhang of solar. I've been in enough meetings and shown people enough of my diverse portfolio, and then they say, isn't this all solar? I mentioned, no, it's not. The movement recently with Morningstar and Sustainalytics having ratings for financial advisors, that's only really happened in the last 6 months, but the ability for a financial advisor to speak intelligently to their client about impact is an important step. Some people have issues with the ratings, but overall it's better than nothing. And I think you're seeing, just look at the board of the conference today. It's, this is happening. The integration of ES&G into an investment process makes a better result. That's the thing that I believed a long time ago, and that's definitely becoming the standard. How it's done and products that are developed, obviously we'll see how it all goes, but we're certainly seeing benefits, and I've talked to a lot of pretty savvy institutions that are starting to really realize this. So if you're not green, it's just another data set to make money. Is much how people look at it, right? So we like that it has both benefits.
So when you say this is happening, like to your mind, and this is a question for Tara as well, I think, and anyone, like who is leading the charge here? Is it individuals? Is it the foundation?
It seems to be everywhere. ESG is part of the CFA curriculum. So every analyst in the last 3 years knows what ES&G is. That's.
But I feel like they do it unwillingly.
Well, the thing is that people have been doing a lot of the G for a long time. Governance. A lot of people have been doing this and just don't call it that, right? And if they did call it that, then they were made fun of. But if you can generate better returns, now you're not being made fun of. Now people are starting to do it. But it's been happening for a long time. But I'd say over the last 18 months, it's certainly picked up. The idea that now that we're in the process of doing a long short fund, how many people are coming out of the woodwork mentioning, oh yeah, we use this particular data set that is super green, and you're like, oh, okay. So it's happening. People just don't talk about it because they're making money. So they don't want as many people to know. But then on the public side, and BlackRock wrote a great report a few weeks ago, and she's partly responsible for this. They highlight exactly on the equity and asset side that paying attention to your carbon footprint helps drive returns. And they lay it out in pretty good detail. So it's something that people might want to ignore, but it's here. So
maybe I could just add that I don't know exactly what you do, sorry, but I think that if you're using ESG and carbon and all these things with an additional lens to have a broader portfolio, I think from a portfolio perspective, I think you're likely to have outperformance. But I think if you're using sort of this ESG and you're using climate change and carbon metrics to limit your portfolio, you're likely to have a. That's like I kind of get from what you're saying. I think there's an important differentiation there, though, right?
Yeah. Oh, yeah. If you're going to get really narrow, then you're going to have to be an active manager. And that's just a different skill set. What we've done is married climate data with a better portfolio construction process. Right. One of the biggest things I think in the equity space that we see is this never-ending pursuit to make something be something it's not. So the S&P 500 is a great index, everyone uses it. The S&P 500 was never meant to be a sustainable investment. It's meant to be an exposure. People spend a lot of time trying to alter that to be green, and it doesn't work. And it's just the simple thing that's just not what it was meant to do. And no matter how many times you try to re-engineer it, it just is what it is. So you have to create broader, newer benchmarks. You know, the first movers on that were one of them. I mean, you know, it's not pretty, but they work, and you absolutely have to be broad, and the more narrow you get, the more it becomes active management, and that is what it is. Right.
So yeah, Tara, what are you seeing in terms of sort of who is at the vanguard, who are the real leaders doing this?
Well, we did research 2 years ago, and we're coming out with Forest Trends is leading the research this time around, where we looked at the conservation marketplace, which includes much of what we do is basically climate. And we found that there's $2 billion that have been allocated, this was 2 years ago, to conservation. Only $1 billion had been put to work, and it was a product issue. It was track record, it was ability to absorb large amounts of capital, it was a number of different issues all around product. And I think, and by the way, that number was supposed to triple over the next 5 years, and I think it's actually accelerating because of people concerned about climate exposure. And I think what we're seeing is both a risk and an opportunity. And so we're seeing climate as a lens for looking at risk across your portfolio, but also an investment opportunity. And so, for example, we closed a very bespoke, high-touch, however you want to call, funky deal earlier this year in Washington, D.C., who has new regulation for stormwater. Stormwater is the fastest and only growing source of pollution in cities. Every time there's a major storm event, all of that pollution usually runs off. Causes issues for drinking water, a lot of health issues. Small businesses are disproportionately affected whenever there's a major flood. I don't know if anybody read, there was a great article in the Times, I think it was last weekend in Texas, what would happen, what's going to happen, not what, you know, when there's a major storm event in Texas with all the refineries around there. Huge issue, opportunity for investment. So we crafted a green infrastructure investment where we are actually building green infrastructure projects in low-income communities, preserving green space, capturing stormwater, and due to regulation in DC, able to trade credits with developers. This was a small deal, as I noted. We had an institutional investor that came in, and this was small for them. They worked really hard with us on the structuring to get it to where we were both comfortable. The point being, they saw the opportunity. They saw that this is a multi-billion-dollar opportunity across the U.S. Infrastructure is, you know, a huge investment. We've seen, I think it's going to be, we've seen a lot less historically now, and I think we're just going to see a shift with climate. And so I think what we're seeing is both a risk, but also this opportunity, and I think it's attracting a lot of different unique players who want to come in early and learn about this, but also see that, you know, want to put large amounts of capital to work.
And that sort of again is where I feel like there is both frustration and opportunity, and this came up when we were having the panel call, and that, you know, you talk to like large institutional investors. Like I was at the University of California for 3 months at the beginning of this year working in their investment office. And if you look at their hedge fund portfolio, they're trying to do like direct deals. They're doing stuff like trying to invest in like motorbikes in Vietnam and getting the revenue stream from that. So they're looking for, you know, funky stuff. I wasn't being mean about you guys, we're putting it at the funky end. Like, so why is it then? Because they want differentiating returns, and they want the yields that come from motorbikes in Vietnam. So why is it that they're going after motorbikes in Vietnam, but they're not necessarily going after like solar in Africa? You know, is this?
Yeah, I can speak a little bit to that. Usually it's really just a high cost of origination, and then that most investors feel like they don't have enough of a deep local expertise to really thoroughly vet and assess the risk of investing in solar in Africa. That's where we are trying, you know, that's our strength. And I think there's also the challenge of investors looking at bigger ticket investment sizes, whereas the solar companies, you know, are really seeking smaller loans at this stage, but the industry has tremendous potential to grow, and if as they scale, they're going to be needing bigger loans, but who's going to come in now when they're really only seeking the smaller sizes? So there's a gap in the ticket size, and that's where we're also trying to bridge and put a portfolio approach so that investors can come in at their, you know, ticket size requirement, but then we can actually put the outflow for the solar companies where their demand is.
So effectively you're saying it's a financial engineering solution, right?
Right.
That can come in and be the bridge between the two.
Right. Yeah, and then also I think for especially emerging markets, it's a lot of the risk currency is a big barrier for investors to come in. So there's going to be there needs to be more work in being able to hedge the currency risk, but also being able to lend in local currencies, because that's essentially what the companies on the ground need.
Can I just add, I think what you're touching on is a really important part that we overlook, which is intermediation. And I think that's what's really needed. Because we're basically, what you see on this panel is crowding in from both ends. When BlackRock enters the machine, the system, and with impact product, that's a huge signal, and that's bringing capital at a different end of the spectrum. And over here, we think of ourselves as some ways as a mini intermediary for conservation of how do we structure these deals, how do we, work on policy, how do we work on all the different pieces to get to where then we can kind of push it. So that when BlackRock's structuring these things, we should be working on other things. That's kind of our mandate. We should be growing this marketplace. In my mind, I don't know if everybody at the Nature Conservancy will agree with me, but when I think about who we want to be when we grow up, that's it. And so I think this intermediation piece is a huge piece. We saw it in microfinance. There's been some well-trodden paths, low-income housing. We're basically following down that path and kind of structuring the same types of vehicles and thinking about it, blended capital, de-risking, first loss, all these different things, so that we can get it to a point where investors get comfortable. I think seeing some of the low-income lenders, and I'm forgetting which low-income lender just got rated. Somebody in the audience, I'm sure, would know. Basically, it just got rated to show that lending to low-income communities, they got a AA, I think it was Moody's rating, isn't actually higher risk. And so all of a sudden, you can attract different types of capital. So that's what we're doing. We're de-risking, we're proving these models, and they can go down and hang out with Ashley at the other end.
And I think that's an interesting role that sort of quasi-governmental institutions can play. So, for example, in terms of like pooled solar, you see the New York Green Bank doing that, or the UK Green Bank doing that. And then for the supranational organizations who can take on the currency hedging risk, IFC is coming with a bond in the next week in terms of ecological offsets that you can get their coupon either in coupon or in red credits. And so they're trying a way to transform the red credit market from some provider into a coupon stream for an institutional investor. So those kind of quasi-governmental bodies can come in and sort of play that role, I think.
Does adaptation need to be happening faster than it is? Paul was urging caution earlier, and that is, the traditional institutional investor approach. It's the needing a 5-year track record, needing to know that these strategies work. But if you think about sort of the needs and the fact that the climate mix or the energy mix today, 20 years from now, needs to be radically different today, do we have 5 years to sit around for the ideas to trickle up from the funky end of the table to the normal end of the table?
I think what you have is a situation where you have a lot of well-meaning people who develop products, and then they try to backfill an investment reason to have those products. Right? And I think that's what you don't need. Right? To the extent that you can get people who have experience in these different sectors or asset classes to apply their knowledge to something and then go off and do it, that's fantastic. So we should urge that. And I think the other bottlenecks, or to kind of address your earlier question as well, is when you're talking to the people who believe in ESG or believe in impact or believe in climate change even, you might be talking to the people who are the responsible investment people on a big pension fund scheme. You might be talking to the trustees, or you might be talking to the CEO or whoever it is that believes in this. But they're not always the people who are making investment decisions, right? So to the extent that the people who are making the investment decisions have learned this in business school now or whatever it is, then I think things start to change, right?
And so what needs to be done, because that's the same thing as the question on sort of the RIA and private wealth side, why, and you take the sort of positive and sort of the negative and sort of beating these guys up for not giving up product. What needs to be done to empower them so they feel like they can? Because I feel like a lot of these guys have all this pressure on them, but they don't know any good investments. They may not even know sort of what you're talking about sometimes. How do we, and it is the targets are really, on the individuals or on the trustees or on the CIO, as opposed to the portfolio manager or the wealth advisor who's out on the front line. Anyone?
So I would say 3 things. I think, first of all, there's been a process of education. And so standard portfolio managers are just now learning about climate risk. This is all new for a lot of us. At the same time, it's happening, I think, on the public side, where the environmental ministers are now learning about financial markets, and that's a mutual, education process that's happening. I think a second thing is leadership really in the space. And so, like you say, you're taking some individual risk when you go out there and you say, I'm going to go carbon neutral. Like, whose decision this is as a treasurers? What if oil rallies back to $70? I mean, what kind of liability am I taking doing this? And having some air cover for decisions like that from, I think, public bodies, again, I'm putting a lot of pressure on public bodies, but leadership in the space is helpful. And I'll use the example of Norge Bank, their sovereign wealth fund, their portfolio. They come out and they publicly state, these are the companies that we're divesting. We're taking a leadership role. And it helps us when I'm looking at what is going to be my divestment list, I'm checking it against theirs. Another example recently is California insurers. So the Department of Insurance in California came out and basically said, and you guys probably already know this, if you're investing in any investment in thermal coal that contributes more than 30% of revenue, we suggest that you disclose that and divest it. And so, again, that spurred the conversation to have a credible institution sort of lead, the dialogue in that space.
Which actually brings up another point which I wanted to raise, which is, has the environmental activism movement been a positive or a negative in terms of getting investors to tackle climate risk and really make change in their investment portfolio?
Well, it's been both positive and negative, right? I mean, it motivates the trustees, it motivates people to think about it, it motivates the endowments particularly to do something. They're not sure what to do. And then it goes too far sometimes and it becomes sort of a backlash.
And does it also kind of build up like resentment and fear against sort of, I as a portfolio manager, now I may have to divest from a bunch of things in divestment, and there's a bunch of people protesting outside and I don't want to give in to the protesters, and I feel bad about my job.
And I'm never leaving the building.
Yeah, exactly, because there's a bunch of protesters outside.
Now, I could say, it's a stranded assets argument has been extremely helpful. It's really elevated the conversation, and it's made people think about stranded assets. And 350.org was very niche a couple of years ago, and now they're building fossil fuel screens that institutional investors are using. And so, any kind of lists or transparency about what companies are doing or investors are doing, I find extremely helpful.
I guess I would say it's also the fact that in the equity markets, energy equities are bad investments. Equities are growth vehicles. Energy companies are a cyclical business selling into a cyclical market. There was sort of a bait and switch on the fracking thing where this was technology and it's all up and up. But really what it ended up being is a bunch of debt equaling the amount of revenue produced by that industry. Those aren't good investments. If you take that to your investment committee on the equity side and say, wow, we're doing this great work here, somebody should point it out that this isn't very good, and it's actually, energy can rally and a bunch of other things, but in the end, you're trying to find, on the equity side, growth businesses that actually are sustainable. And some of the traditional approaches need to be supplemented by other forms of data to help uncover. If you are going to invest in energy, I know what you own, because it's a very capital-intensive business, and there's room for lots of mistakes. I think you can look at the whole sector and see it, and that goes beyond. It goes beyond just that sector. But it's just interesting being in front of investment committees and hearing, kind of a traditional approach when they're paid to make returns. I think that this is part of this conversation. People are recognizing, okay, I may have to do this a particular way, that's fine, but I better be able to justify the risk. And it's interesting to hear investment committees talk about risk as if what they're doing currently isn't risky.
Question.
Are you talking about equity investments in alternative energy or traditional energy?
Well, equity investing in general is risky, right? I guess I would say. But I would say that if you're buying Chevron here, you're buying a company that's paying more than it earns. And really, if you ran Chevron, you should kind of adopt the stranded asset risk and be the first mover in the U.S. and become a royalty trust and pay out investors.
So that's traditional and that's public investing,
right,
as opposed to private growth investing.
Well,
because in the alternative space, there have been some very interesting and very attractive investments in equity.
I only do public. So
okay, that's what I just wanted to clarify.
The private side, you know a lot more about that than I do. But on the public side, public equities, let's pretty much look at the sector. It's paying out more than it earns, and it's got a CapEx budget that doesn't make sense. It's that simple. It's not controversial.
So a lot of times conversations around climate change and investing really focuses on mitigation. But I know something we've been looking at is adaptation and resiliency. And I think sort of the notion of needing to deploy all types of capital, public, private, local, global, towards adaptation and resilience is incredibly important. And time is of the essence here as well, though it's sort of different from mitigation. I would love to hear any comments you guys could share on how you're thinking about climate adaptation in your investments, or if it's even something that's sort of on your agenda at this point.
You've been working with a group that's been doing that, right?
Yeah, so there's a group called GARI, which is Global Adaptation and Resilience Investment, which meets here in New York sometimes. I think it's a really interesting group. You might want to come down sometime for a meeting. Well, we were in Washington at the White House, actually. They had a meeting there in the spring, and they were talking about adaptation and resilience. And my feedback to the White House group was, as an institutional investor, we've never heard about this term adaptation and resilience. Right? So, I mean, it's an interesting concept, and I'll tell you, I mean, the way we're looking at it with what we're doing right now is we're doing an energy transition fund, right? And our argument, which some groups don't like, is, you know, if there's a power pool in the U.S. where you can build combined cycle gas-fired power plants and remove coal-fired power plants, and you have better energy produced cheaper with less carbon, you should do it. So in the energy space, I think there's a whole transition going on. And the more people can be realistic that we do need power that's sort of there when you turn the switch, so that it can run our hospitals and our schools, but we need to transition. I think that investors would do better to take that attitude. There's a lot that can be done to reduce the greenhouse gases and carbon output in a responsible way that's good for the portfolio and that makes sense. And I think where some institutions can't get involved right now is just because the yields are too low and the straight renewable assets. So if you want to bid into a $200 million or $400 million U.S. renewable project, you're getting a 6 to 8% yield, right? And so I think they're just too low to be attractive for a lot of investors, and that's hampering what could be a faster transition. Does that make sense?
Wait, can I?
That's a great.
Can I sorry, go ahead. It was a follow up to that. We'll come back. Sorry.
I don't know. Yours might be more relevant.
Okay, go ahead.
You were pretty good.
Go ahead. No, go ahead.
Do a quick follow-up, and then you, and then there's a question back to the room, and then people over there.
No, you just said something 6 to 7%. I don't. But compared to other fixed income.
Oh, it's a great. I mean,
So
there's no
why
money
was
to be made
that?
anywhere in the world these days, right? So it's a great return.
But yet, because it's a renewable energy contracted 20 years.
What we do is I mean,
Not for you specifically. I'm really speaking to sort of a general observation. I think of most institutional investors.
Right. So what we're doing is we're taking some development risk, which is a shorter term horizon. So we're investing for 3 to 5 years. But typically, infrastructure investors are investing for 10 to 20 years, and that's a long time to be locked in. And typically, it's in the private markets bucket, which is maybe 20% or 30% of a portfolio, right? So they don't have that much bandwidth to actually allocate outside of that for river.
And some of this also gets to the question about the need or not to disintermediate asset management, right? That private equity firms aren't willing to do the kinds of investments that don't make them enough money to take their fees, so therefore do institutional asset owners need to go direct, but can you go direct because some of you are in a bunch
the
of stuff?
teams, the resources, and the fees are high, right? So it's
I want to get back to the latest point about adaptation versus mitigation. And I think that's a nuance that gets lost in a lot of climate conversations, where when we think about adaptation, we're thinking about making projects resilient to physical climate change. Right? That's very different than thinking about what are my dollars doing now to mitigate that climate change coming. And this is a conversation that has it's picked up its head in the green bond community because there has been pressure. There's obviously a lot of public pressure to think about funding adaptation. But I think the greener investors will push back on that a little bit and say, you know what, if I'm going to put my money now in green, I'd really rather focus on mitigation with what I have and think about adaptation is just part of generic ESG in terms of resiliency of infrastructure or companies. That's just part of their generic ESG. And so there has been some pressure in the green bond community to push adaptation projects within the green bond space to think about that they're climate friendly. I don't know if they're necessarily climate friendly. They're definitely beneficial if we have physical climate change, but there's a big difference there when you talk about those two different topics.
My quick question was just, and I'm sort of with this because I'm reading a book about offshoring and factory workers losing their jobs, and it makes me think about the coal industry. And that's a big argument, a big political argument. I mean, that part of the world has been devastated by the loss of jobs, and loss not just in coal, but in every, factories and So I was just wondering if anybody considers, in terms of mitigation or adaptation, how do you help these people adapt to the fact that now there is no industry for them whatsoever? I'm not a proponent of coal. I'm just saying, like, these people on the ground who are talking about
Something
their
needs to be
jobs.
done. I mean, there needs to be a transition to solar jobs or something. I mean, Wyoming has a wind tax.
Right.
I mean, why do you have a wind tax if you could have a lot of wind produced?
You need to talk to Ivan about that, because Ivan has good views on this.
Okay.
I also think, I think we need to start looking at what's going on in the region. So the Central Appalachian region is a huge issue. There's a lot of funders, foundations that work in that region. We are looking at it through forestry. So we were looking at a property, we're diligencing a property as part of a larger forestry footprint that we're trying to, or a product that we're trying to put together. And we started looking at the job loss because there's mountaintop removal that we're looking to prevent. And we found out that there are actually 55,000 timber jobs, and this was a year and a half ago, and 5,000 coal jobs. And so what we need to start thinking about is actually this just transition. Because you can transition to timber in that region, but all of a sudden you're taking a critical climate habitat. I don't know if anybody has seen the map of the migratory corridor, but it goes straight through the Central Alps. So you're going to all of a sudden, basically clear cut. So how do we transition not just to other jobs, but more sustainable jobs? And I think how do we think about holistically our portfolios and our investments to start thinking about the communities? How do we also fund local, there's some great groups like MESA that are working in that Central Appalachian region that are doing a lot of this transition. And so that just transition that's happening. And I think that's part of this holistic. When we talk about climate, I think and I loved your question about resiliency and adaptation because that's really often touches down on the human side of things. And so often we're just thinking about greenhouse gas emissions, which isn't important, and I'm not saying it's not, but I think there's a much more holistic approach that we need to take. And I think coal, there's some really great opportunities to structure some interesting vehicles that can keep coal on the ground and also benefit communities. And so hopefully we'll see more.
Thank you. Hi, I'm Katie Walsh from CDP, Carbon Disclosure Project, and I run our SEA program for North America. We have about 500 cities that just went through the CDP reporting process on climate, talking about their mitigation activities and adaptation and what they want to be doing with the private sector. So there's a lot of ideas out there about what cities want to do, and we just ran actually a financing workshop on Sunday in Toronto with a subset of American cities specifically. So the challenge that they have, and what I'm hearing in terms of the presentation, where you're talking about structuring and working with them, they are struggling, they want to work with the private sector, but even to get them to the matchmaking, right, it's not even the structuring point, it's the selection of their projects, and it's the identification, with others if the size is right to match up with others. So I guess what I want to, pose to all of you is, to grow the green bonds market, to get more cities to issue bonds. CDP, we're actively trying to support and educate sustainability officers so they can talk to their CFOs. And you'd like to see the flows, increase. And so the question is, are you seeing enough flows on infrastructure? And what are your entities doing to increase that, to actually get those flows to be moving through the system? Because that's something we're trying to do.
I think it's a critical question, and I would say it even goes deeper, it's cultural. So a lot of these, if we think about our green infrastructure practice is looking across the U.S., there's 770 plus cities that are under consent decree from the EPA for their mismanagement of their stormwater. Only one has put in any regulation that enables private capital to come in and sit on top. So Craig Holland, who leads our practice, actually sits on, I think now, 3 committees advising them in Detroit on how to set up regulation. He's been doing this for a year and a half now. And this goes back to, it doesn't make sense for the non-punky people to be playing in the space, but it makes sense for an NGO who is funded philanthropically to take that philanthropic capital, which is true risk capital, to try to prop up these deals by dedicating. Alyssa Valderrama from NRDC does great work here, basically doing technical assistance with cities to help them think this through. But I think it's a huge issue that we have. There's a desire there, and there's that gap. We see opportunity to leverage private capital. We need it oftentimes because also we don't have the ability to issue debt for one reason or another. But there's that gap that we need to overcome, and it doesn't make sense for less funky to play in there, and that's really the work that we're trying to do.
I guess I would add that, so I think that the green bond market is a huge opportunity for the green space. Number one, because they have the projects, and number two, because it's primarily a retail market, and green bonds are really resonating with retail. I think it's been a little bit of a wasted opportunity in the muni space. When you think about, when I talk about the green bond market, I'm talking about really the 150 billion labeled green bond market that we have now, which has terrific standards around it under the green bond principles. In most of the bonds you see they're very strict, they have impact reporting, and second party opinion. The muni green bond market is a little bit of the Wild West right now. So muni issuers are coming and they're labeling bonds as green, and they're just not as defensible from a green label perspective as the rest of the green bond market. So I think there's a big opportunity for some guidance in that space. We have, talked to the U.S. Treasury about green bond guidance for munis. Climate Bonds Initiative, I know, is doing some work around there. But having standards for a green bond label in the muni space could be quite powerful.
Joyce, question here.
Sure. Hi, I'm Leslie Sandler with Green Century. And could you comment on anyone who thinks they have someone to say around the shareholder advocacy work impact on public equities and how you see that, what you're most excited about?
The equity guy.
Yeah, the equity guy. So in the ETF, that would be the one place that we can't do much with. But in our more active work, where we're excited, is the ability to drive more disclosure. So you have situations where you have companies like a Tesla, where they are doing very good work on their environmental impact, but not telling anybody about it, so nobody knows, right? I mean, it's just assumed. And that's something where, with this growing change of the Morningstar reports and other things that people are doing, there's a real added benefit for them starting to do that. Certainly, we see a lot of people bringing proxy to disclosing more of the carbon footprint, and across lots of industries, trucking, and it seems to be, even the companies seem to be agreeing to do it. So there's, of course, a lot of the proxy work being done on the governance space. I guess what I'm most excited about that's related to that is the initiatives at the stock exchange level, trying to have companies disclose very high-level ESG data to be listed. And just that simple process would really allow investors very easily to at least see some basic stuff across all these companies. The London Stock Exchange, I believe, requires a decent amount of this currently, and the NASDAQ Exchange is leading an initiative in the States. That certainly would be a big positive, and then there's many other groups, as you saw, and other people that people know in this room, that seem to be gaining even more traction every year in terms of their ability to bring issues to the table.
Another question in the back.
Yeah, as a follow-up question to that, it's been an enormous frustration for those of us who invested with people like Vanguard, just to throw somebody under the bus, that they are not supporting a lot of those shareholder initiatives, even though I think many of us in this room feel this is in the long-term shareholders' best interest. So, BlackRock, a really big company, how are you starting to coordinate some of those, the voting? I mean, does it happen? Does one person kind of chair a committee that decides how to vote all those? It's clear as an observer of the industry that many financial institutions are hesitant to support these kinds of shareholder resolutions because they don't want to be called out themselves on some of these awkward things. So the neutral for many asset managers, and really big ones that do vote trillions of dollars of shares every year, who could really swing the needle for everybody else, that they don't, on a practical basis, regularly support these kinds of shareholder initiatives. Can you comment? Anybody in the public space?
Yeah, so I speak on a lot of panels, and everybody wants to know why doesn't BlackRock vote on the Exxon proxy? That's like the question that I get all the time. And I'll tell you, so you have to understand a little bit about our process, and we are, for a lot of these companies, the majority shareholder. And we are, just because we're not actively voting specific proxies does not mean that we are not an active shareholder. So there's an enormous amount of engagement that goes on at BlackRock with these companies. We have a 14-person team that just engages companies on these issues. And so not to pick and choose, when there are ESG proposals that get put forward that management supports, generally we do go on and vote with management on that. As a general rule, the way that BlackRock operates is that we do not vote E&S proxies publicly. That we vote, if we don't like what the company is doing, that we will vote against management. And you can see that in Exxon. We got a lot of heat publicly about our Exxon vote that we didn't agree to vote for them to disclose on the 2-degree trajectory, which, by the way, is a very difficult trajectory to report on because you have to make a lot of assumptions under that. Are you picking IEA 450 2-degree scenario? What 2-degree scenario are you choosing? And so we actually voted against some board members on our governance voting because we had been engaging on climate issues. We're a member of the FSB task force. We're pushing for transparency. We're engaging all the time on these issues. So as a general rule across the board, BlackRock does not vote E&S proxies when they are against management. We will engage on these issues. If we don't think that we're getting traction with management on the issues that we're engaging on, then we will vote against management. The argument for that is that we think that sometimes these issues are long-term issues, and that we think sometimes they're not best to be played with the big bat that BlackRock has in the public space, and that we have regular conversations with these companies. We're not a small shareholder that can't get a meeting with management. And so, to publicly use that voice for smaller players is sometimes, a little bit of a better tool for us. We think we like to engage on these things privately and over a longer period of time. So that's the answer that, that we have on that. There's a lot of discussion that goes on as these issues, and I can assure you that we're engaging companies on climate risk all the time.
I feel bad for BlackRock on that issue because it does feel a bit like you're getting slapped on the wrist for being amongst the more progressive asset managers. I think in general, to your question though, on the sort of the inner mutual fund assets, part of the answer is going to be fintech and new asset managers coming up and new products coming up that recognize the desire on the part of investors to engage and how to better leverage that, and that in turn will force the vanguards of this world to pay more attention. So I think it is starting to change, but it's also a place where sort of US consumers need to vote with your feet in a way that is different from the institutional investor community. Anyone else?
And I'll also add, there are some nuances there. So, except for ETFs, asset owners can vote their own proxies. They don't necessarily have to have BlackRock vote their proxies. And on some of our ESG funds, we will actually vote with different. We will not just abstain from ENS. We will actually vote ENS proxies on some of our ESG funds.
All right, so we're at 12:31. We were a little late in starting, so does anyone like to do one more question? Or I have one more question, if no one else does. Okay, my question, Elon Musk, robot sent from the future to haunt us, or impact genius? Connor.
I've already answered this question, but a bit of both, I think.
But he looks like a robot sent from the future and he's sending people into Mars. That's scary. And it's a legitimate question in that, is what he is doing, like, if we're talking about climate, and we're talking about climate investing, and, Elon Musk is sort of the public market, figure in this, but I don't understand what he's doing with the Tesla deal, and is that a good or a bad thing? And what does it mean for clean investing and sort of movement towards this, if in fact it turns out to be terrible? Go ahead, Connor.
Well, if it turns out to be terrible, I mean, certainly from a traditional governance standpoint, it doesn't look great, right? You have family members, and there's nothing good governance-wise that's going on there. It doesn't mean it's not a good deal. I can't speak deeply enough to the Solar City Tesla combination. It does seem like the equity markets keep giving him money, so somebody's believing that. But from a pure governance standpoint, I don't think it would fly for anybody in this room. If it wasn't Tesla Solar City, you wouldn't be as for it.
So which begs the question, does he get something of a free pass, at least with the ESG impact round, for being sort of the arguably most successful entrepreneur he can point to?
Yeah, he seems to.
Okay, anyone else? Questions? No one else wants to take credit like Elon Musk.
I'd say impact genius. I put him on that campaign issues. I think he's giving away his patents.
Yeah, that's
And I'll say that his work on the energy storage is something that's going to be benefiting, solar companies in Africa. That's